Urgent analytical velocity. The Vietnamese equity market moves with exceptional velocity. When a macro policy announcement hits the wire, a surging wave of capital immediately floods the system. This creates a mismatch between rapid data flow and the underlying market structure, as traders move based on headlines rather than execution mechanics. Retail investors often misprice state-owned enterprises by treating broad government decrees as immediate execution orders. A high-level policy document stating an intent to restructure is often acted upon as if it were a directive to sell shares on the exchange the following day. Historically, this has led to significant capital destruction. Investors chase unverified divestment rumors, bidding up illiquid state-linked tickers, only to see that speculative premium disappear when the bureaucratic process takes years to materialize. Institutional capital operates on a different frequency. These participants do not trade on intent. They wait for verified corporate events, specifically the legal documents that authorize an actual change in the share structure. This risk matrix plots market rumor on the horizontal axis against a verified legal execution plan on the vertical. The bottom right quadrant, high rumor, zero legal plan, is the area of highest risk. Evaluating state capital events requires looking through this dual lens of market speculation versus legal reality. Buying Vietnamese state equities based purely on a policy headline without a concrete corporate catalyst frequently results in the erosion of portfolio alpha. Right now, the focal point of market speculation is Decision 40, issued in August 2026. It outlines the framework for the 2026 to 2030 state capital restructuring cycle. Decision 40 is strictly a quantitative legal gateway for state asset optimization. It is not an order for a public offering or an immediate block trade on the exchange. The financial scale of this mandate is substantial, covering trillions of dong across multiple sectors, as the government attempts to balance capital preservation with modernizing operations. To generate institutional alpha here, the bureaucratic legal pipeline must be separated from actual market liquidity events. A document moving between ministries is a legal event. A public auction of state shares is a liquidity event. Identifying opportunities in this cycle requires a specific focus on the hierarchical mechanics of Vietnamese state capital law. Vietnamese macroeconomic strategy originates from a strict hierarchy of physical institutional authority. To trace a divestment, we start at the point of origin. The foundation for this cycle is Politburo Resolution 79. It replaced passive capital preservation with a requirement for active restructuring and reinvestment in key sectors. This political mandate is translated into legal mechanics through Decree 57. This document provides the actual execution tools, detailing the procedures for equitization and capital transfers. Decree 57 introduces specific valuation mechanisms, such as extending the amortization period for brand value from 5 years to 10 years. This directly changes how intangible assets hit the balance sheet during a restructuring. Resolution 29 then assigns these legal mechanics to specific ministries and local authorities, requiring them to review their individual portfolios. Decision 40 sits immediately below that. It acts as a quantitative sorting algorithm applied to individual state assets, determining the exact required government ownership. Finally, Directive 52 acts as the enforcement mechanism, applying strict deadlines to the bureaucratic apparatus to ensure compliance. This exact 5-step hierarchy is mandatory. Skipping any step makes a divestment thesis legally impossible. Decision 40 establishes 4 ownership brackets: 100%, over 65, 50 to 65, and 50% or less. For multi-sector enterprises, classification relies on a quantitative rule. The bracket is dictated by the sector providing the largest revenue over 3 trailing years. This trailing revenue rule replaces subjective ministry classification with a mathematical outcome based on historical financial performance.
Institutional investors are specifically focused on the bracket mandating state ownership of 50% or less. The explicit legal directive for this bracket is the mandatory transfer of representation rights away from the currently governing ministries. Decision 40 acts as a mechanical, backward-looking sorting tool based on revenue. It does not offer forward-looking projections of market liquidity. A common misconception is that a mandate to reduce state ownership below 50% results in an immediate public stock sale. The actual legal requirement is that state capital in this bracket must first be transferred to specialized state capital investment corporations like SCIC or to peer state-owned enterprises, bypassing the public exchange. This transfer process is an internal asset consolidation and governance restructuring phase. The goal of this consolidation is to reorganize asset value and balance sheets under professional management before a potential sale is even considered. During this consolidation, no new liquidity or free float is introduced to the HOSE or HNX exchanges. Reacting to an SCIC transfer rumor often leaves retail capital in illiquid positions while the state reorganizes its assets off-market. To find truly actionable catalysts, the investor's focus must shift from macro-level legal frameworks to micro-enterprise-level events. This diagram shows the singular document required to validate any market event, the 5-year capital restructuring plan. It details the target ownership percentage, the execution method, and a binding timeline. Without an officially approved 5-year plan, any discussion of share issuance or a strategic sale is speculation. Directive 52 applied extreme urgency to this, imposing a hard deadline of August 12, 2026 for the big 3 systemic state banks, BIDV, Viettinbank, and Vietcombank, to submit their restructuring plans. A secondary deadline of August 31, 2026 was set for all other ministries and state-owned enterprises to submit their respective capital plans. Forcing every state entity to file their plans within this window creates a bottleneck of actionable catalysts entering the 4th quarter of 2026. Institutional capital waits for these specific 5-year plans to be finalized. Earlier movement is often just legislative noise. Knowing the timeline allows investors to position themselves based on these 5-year plans. This is the financial landscape where these reorganized state assets will eventually be priced and traded. The first step is identifying sectors explicitly cleared for state exit, such as infrastructure, ports, and consumer goods. This 4-factor VIP filter starts with deep value, identifying enterprises trading at significant price-to-book discounts relative to their underlying hard assets. The second factor confirms the enterprise has the structural capacity for margin expansion once state bureaucratic constraints are removed. The third factor ensures sufficient daily trading liquidity to accommodate institutional position sizing. The final factor is a stable, historical cash dividend yield, which establishes a return floor. Applying this filter creates a margin of safety, as the dividend yield compensates the investor for the time required for bureaucratic execution. Even with a precise filter, state execution remains the dominant variable. The bull scenario involves rapid, transparent execution of the 5-year plans, where the market reprices these assets based on their newly reorganized balance sheets. The base scenario accounts for friction. Internal audits and inter-ministry negotiations cause fragmented delays across the portfolio. The strategy here is to hold the dividend-paying assets and ignore market noise. The bear scenario occurs when unverified rumors cause illiquid names to spike, followed by retail capitulation when public sales fail to materialize. Decision 40 establishes the legal classification of these entities, but it does not mandate a market transaction. Institutional alpha is generated at the intersection of verified legal catalysts and deep financial value, never by trading the word divestment alone.